Hello guys, welcome to the Financial Academy. So in today's video episode, I'm going to be teaching you guys the full introduction and the full course tutorial on the foreign exchange market and the foreign exchange business, which is also known as Forex trading. Yes, of course. So in today's video episode, I'm going to be teaching you anything and everything you need to know from what is Forex to the end. So this video is going to be a very long video. All I need you to for you to do is for you to stay tuned and watch this video from the beginning to the end, because it promises to be awesome. Because I will teach you everything you need to know from the introduction of what is foreign exchange to the end of the end of money management in the forex market. So everything you need to know to grasp and start the business of foreign exchange business or forex trading, you may call it, is what you need in this video. So make sure you watch this video from the beginning to the end. Like this video, subscribe to my YouTube channel, and also comment down below if you have any single question concerning this video. Without any further ado and without wasting much of our time, let's begin right now. Then, first of all, the first thing we need to know you need to do is this video is divided into two segments. Number one is the introduction, and number two is the full tutorial on forex trading. So first of all, I'm going to be telling you the full introduction on this business of forex trading. Then the second part, I'm going to be telling you the full tutorial, everything you need to know about forex trading. So it is divided into two segments, because any business that you want to venture in, you need to know the introduction first. Then before you can be able to know the full details of the business. Understand? So let's begin with introduction. Mind me, I will be using my phone. Understand? Because all these things I have already jotted it down in my notepad. I'll be using my phone to reading it out for you, and also to be explaining things in detail for you. Understand? So don't mind me if I'm looking down. That's why don't mind me if you are looking down, because I'm using my smartphone to explain these things for you, because it's a very long topic. So I need to break these things down for you. Understand? So let's begin right now. Full forex trading introduction for beginners. So if you're a beginner, I'm telling you the introduction from the beginning to the end. Number one thing is, what is foreign exchange? First of all, understand. Let's forget about forex trading first. What is foreign exchange? Foreign exchange is very simple. If you have ever wondered why people are so curious about foreign exchange, foreign exchange is a popular word. It's a transaction between two countries, understand, in their local currencies, understand. And also, foreign exchange business is the business whereby individuals or countries exchange one currencies or the other. You understand? And is a global marketplace. Yes, of course. Foreign exchange is a global marketplace. And the business is worth about $7.1 trillion, which means that it is being transacted every single day. More than $7.1 trillion is being transacted in the foreign exchange market. And you can see it is a very huge market. So foreign exchange business is a very huge market. It's a market for everybody. $7.1 trillion every single day is a huge money in this marketplace. And it is the biggest financial market in the world. Yes, of course. For those of you who doesn't know, the foreign exchange market is the biggest financial market in the world. Anything you need to know, any market at all, whether it is crypto market, indices market, stock market, forex trading is by far the biggest market and has the biggest and the largest liquidity you can ever think of. So it's a very big market for everybody to perform and for everybody to join. The next thing you need to know is, who are the people or the participants in this business. Understand? But before I dive in, I need to explain something for you. What is forex trading? Forex trading is the simultaneous buying and selling of currencies. Understand? It's the simultaneous buying and selling of currencies. Understand? You are trading a country's currency and another country's currency. It is what you call foreign exchange trading. Let me give for example. If you want to travel from, let me say, from Nigeria to America, yes, of course, you have your naira, right? Because Nigeria is using naira and America is using dollar. So for example, you want to travel to America, you need to exchange your naira to dollar before you can be able to travel. Because if you carry your naira and go to United States, I want to buy something with it, you can't purchase something with it because those countries are not using the naira currency. So you have to go to money changer and exchange the money from naira to dollar. You understand? before you can be able to travel so that you can use the dollar to transact over there in the United States. Through that process, you have already performed forex trading without even you knowing that you have already performed forex trading. You understand? So this is a layman understanding I can give to you for you to understand what forex trading is all about. Let me give you another instance again. Assuming a company like Toyota want to buy rubber materials for their tires in India, what they need to do is that Toyota is a company that is located in Japan. What they will do is this: they will have to sell their Japanese yen. When they sell their Japanese yen, they have to buy Indian rupee. When they buy Indian rupee, then they can go to India and purchase their tire for purchase their rubber tires for their materials. The same thing is if you are in Dubai and you want to stay your vacation in Dubai, if you come with the United States dollar in Dubai, you can't spend the United States dollar in Dubai. What you need to do is to exchange your dollar to dirham. Yes, if you exchange your dollar to dirham, then they will give you their local currencies. You can begin to trade and transact in everything you are not doing in Dubai. Then have fun. Then if you want to go back again, you can now change it back again to normal currencies and then leave the country. So doing those things, you have already transacted a foreign exchange or you have already traded forex, but without even knowing. But in this aspect of our business, you'll be trading forex with your smartphone or your laptop and be having access to the real-time market price in the foreign exchange market. You understand? So aside from that, these are the things that you need to know, learn, and understand before diving into the foreign exchange business. Because you can't just wake up tomorrow or wake up one morning and start doing a business without even without even you understanding the basis or the real deals of the business. You just wake up tomorrow morning and just start business. No. So you need to know in details what this business entails, what this business is all about. Then you can move ahead. So let's continue. The next thing you need to know is how the forex market works. In this introduction, you need to know how the forex market works because every business that you are doing have procedures, have terms and conditions, have step-by-step process. So it is not different from foreign exchange. So you need to know how the business of foreign exchange works so that you get able to do the business successfully. You understand? And for those of you who will be wondering, is this business reliable? How long has this business been? As old as money is, so as old as foreign exchange has been. Because this business of foreign exchange has been a business for over 300 years since the existence of money and since the existence of traveling and tourism. Foreign exchange has been in existence, and this business has been in existence for over 100 and something years, 200 and something years, 300 and something years. So this is not the business that you just begin today and end tomorrow. No, this has been the business that has been for over so many years before it now transcends into the digital world. Are you getting my point right now? So as far as business, as far as money is concerned, foreign exchange will continue. Once there is existence of money in the whole world, foreign exchange will continue because people will buy something across the globe, and company will buy something across the globe, and people will travel across the globe, and people will transact money in different currencies across the globe. Foreign exchange will continue to grow and grow and grow and grow, even way more bigger. You're getting my point now? So don't panic about how long the business has been. It has been over the years, decades, even centuries. So it is not the business that just started today and has the likely to end tomorrow. No, the business has been in existence for over a long period of time. So don't panic about that. Let's continue. How the market works. Like as I told you previously, how this market works. This market works in different ways. You understand? Because we have different trading sections. Because each country have their time zone. For example, New York have their own time zone. Germany has their own time zone. UK has their own time zone. So all these countries have different time zone. The time New York will be sleeping, the UK or the England people are awake. For example, the time Indian people or Asian people are sleeping, Germany are awake. So have different section or the sessions of the foreign exchange market. You have the New York session, you have the London session, you have the Asian session, and also some people have the Australia Asian. But all these things that still have time zone. Understand? Asia, and I mean Asia, I mean Japan, China, and other Asian countries, Malaysia. Then when you talk about New York, you talk about Americans, South Americans, and other neighboring countries in American continent. Then you talk about you talk about London session. You talk about England, Frankfurt, Germany, and other European countries, and also some West African countries that are also in this session. So there are many sessions in the foreign exchange market. So you need to know your own time zone for you to trade the forex market. But in this time zone, you have what we call overlap. Overlap simply means the time where when one time zone and another time zone meet together, and there are more liquidity and there are more transaction in that. And that time zone is the New York session and the London session, because the London session and the New York session at some point during the trading hours they meet together, and there are too much volume and there are too much liquidity that goes through during those sessions. So if you want to be trading, you'll be trading more on the New York session and the London session instead of you trading during the time that the Asia or the Asia or other session will be sleeping. No, you'll be trading when there is more liquidity and there is more transaction in the market, so that your spread will be very tight, so that you won't have a wide spread, and so that your broker will not collect too much amount of commission when they are transacting the trade for you. That is number one. Then the next thing you need to know is who are the participants in the forex market. Yes, of course, you need to know who are the participants in the foreign exchange market, because it is a very important thing you need to know, because every business have people who are in the businesses. Understand? So in this type of our business, which is forex, we have different market participants. Number one is the central banks. Yes, of course. On the central banks, we have the commercial banks. From the commercial banks, we have the hedge funds. From the hedge funds, we have the big companies. From the big company, we have the brokerage firm. Then from the brokerage firm, then we have the individuals, which is now me and you, who are now trading the market. Then let me begin from the central bank. Central bank of every country trade the foreign exchange market in order to control their monetary policies. Yes, of course, central bank of each country trade forex in order to control their monetary policies and watch their currency so that it won't be devalued. Then the commercial banks also trade currencies, also trade forex in order to make profit from foreign exchange. Then the hedge fund, the investors hedge fund also trade currencies, also trade forex in order to make profit or in order to make money for their clients or for themselves, because all these hedge funds, there are people who have huge amount of money that want to trade. Then the brokerage firm are the people who facilitate trade or who place trade or who execute trade to the individual or to individual traders. They also make money from foreign exchange. Then we have the retail traders, which is us, which is the individual. Our money is 0.000% of what the total amount of money that is being circulated in the forex market is. You understand? So our money is a fraction of what will be used to trade the market. But we'll be trading the forex market, but our money doesn't move the market. No. The money that moves the market is the money of hedge funds, big banks like JP Morgan and Bank of America. These are the big institutions that move the market, because they have the huge amount of money that can use to move an order in the market. But the retailers, who are the individual traders, their money is just small amount of money. Even if you are trading with $1 million, it is still a small amount of money to compare how much the big banks and the hedge funds are putting in a particular transaction or in a particular trade. Understand? So these are the things you need to know and understand. So everybody, once you have the knowledge and you have this and you can be able to learn the skill of forex trading, and you are profitable with it, it will change your life a lot. Let's continue. The next thing you need to know is types of forex traders. Yes, of course, you need to know and understand what are the types of forex traders. Understand? So as business grows, there are different type of people in the business. Understand? So there are different type of forex traders in the business. First of all, we have scalpers, we have day traders, we have position traders, and we have swing traders. You understand? So let me explain to this thing one after the other. Who are scalpers? Scalpers are people who trade but within a minute to minute in the market. So they don't spend too much time on the chart. They just trade between 1 minute and 30 minutes. They are scalpers. While day traders are people who trade forex as during the day. They can stay in the trade throughout the whole day, then they can move out. Understand? So mainly their time frame start from, let me say, from 1 hour, 30 minutes and 15 minutes. Some even make use of 4 hours. But their trading transaction only start from the beginning of the day to the end of the day. So that they won't leave their trade overnight. No. These people are day traders. They are trading within the same day. Then swing traders, that these people are still traders, but different type of traders. So swing traders are potentially people who are trading forex. Maybe if they can leave their trade, run for over a week or 2 weeks or even 3 weeks. Some even leave their trade a month. Understand? These people are called swing traders. These people are people who ride the market. When I mean who ride the market, they are trading the market based on swing level. You understand? So I will dive more details when I will be teaching you technical analysis. So let me not just rush these things. You understand? I will be dive more details when I will be teaching you and breaking down what is technical analysis and other words. Understand? So, but now just know the meaning of swing traders. There are people who take trade, but a more longer period of time. And I mean this, they can trade from Monday to Friday, or even for 2 weeks. They still have position left out on their trade. These people are called swing traders. Then position traders are more of people who trade for a long time. They can keep the trade running for months, even years. Like I've seen some people who have placed a trade for 3 years in a single position. But these people, they mainly make use of the weekly time frame and the monthly time frame. Because these people are the people that have a huge amount of money that are investing in a long term. So these people are position traders. As an individual or as a retail trader, you won't be going as a position trader. No, you'll be going through swing trading or scalping or day trading, depending on the kind of depending on the kind of a personality. You can choose between day trading, swing trading, and scalping. You get the point. But as time goes on, I will explain to you better the kind of personality that can go for swing trading, the kind of personality that can go for day trading, and the kind of personality that can go for swing trading. Let's continue. Common mistakes new traders make. Understand? Because every business, there are mistakes new traders make. So I'm going to be telling you this introduction. Common mistake you need to avoid if you are starting out as a foreign exchange business, as a forex trader. Because if you can be able to avoid this common mistake that so many traders face, I promise you, you'll be far more ahead of other people in the market. Number one common mistake is over leveraging or over trading. When I mean over leveraging, is making use of too much, taking too much risk in the market, or over trading, taking too much trade at a particular time. Maybe let me say you have a $500 account and you are maxing your account. You can take 5 trades, 10 trades at the same time. In this process, you can blow your account within a twinkle of an eye. You can blow your account, and this is number one common mistake traders who are new in this business make. Number two is trading without a plan. Understand? In trading, there is what we call trading plan. Some traders doesn't have a trading plan, and it's very, very bad. Some traders doesn't have a trading plan. This thing is more like you are doing a business, but you don't have plan for the business. You don't have procedures on how the business or on how you are doing the business. Definitely the business will collapse. So the same thing that comes with forex. You need to have plan in place. Plan to enter your trade. Plan to how you execute your trade. Plan on the kind of trader you are. Plan on how, whether you're trading the currency or whether you're trading the gold. You need to have a strategic plan in place. Number three is strategy. High and well proven strategy. Some forex traders are just moving around the market, just trading anything they see in the market, because they don't have a perfect strategy But I mean anyway, there is no perfect strategy in the market, because somehow you definitely lose in the market. But the most important thing is have a strategy that have proven itself to the test of time, that out of 10 trades you make more money than you lose. Then you can call yourself a profitable trader. If the strategy you have is making more losses than profit, that means you don't have a profitable strategy. You need to bend down and study your strategy, and make sure that out of 10 times, at least you'll be making seven winning or 8 winnings, then losing 2, because this is what makes you a profitable trader. And when you don't have a strategy that doesn't work, no wahala, no problem. Watch this video. I will be telling you strategy that works in the market. At least you can be using to make small amount of money as a beginner who is trading the forex market. This is number 3. Number 4 is they are too emotional. Beginners are too emotional in the market. Yes, of course. If you are too emotional in the market, you won't be profitable. You need to control your emotion when you are trading the market. Let me tell you something. The moment you press the buy button or the sell button, whichever way, just count the money that you place as loss. At this moment, this thing, it won't disturb you at heart, because you have already know that this money is a bygone. When it comes to your favor, yes, it's a winning trade. But for that moment, the moment you place a buy order or sell order, just forget about the money. All you need to do is just to control your psychology, control your emotion, and control your risk management, which is the next thing I'll be diving into. Some trader doesn't have a risk management, and it's a very bad thing for you as a trader who is beginning to don't have a risk management, because that it will render you useless if it doesn't take time. Understand? Let's go over to the fifth one, which is risk management. Oh my goodness. 90% of traders in the market doesn't apply proper risk management, and it's a very bad thing. Understand? Yes, it is good for you to be conservative as a trader, and at the same time for you to be aggressive as a trader. Yes, it is good for you to be aggressive, because if you can be more aggressive, you can make more money. But sometimes as a trader, you need to take a calculated risk, because we live to fight another day. Because this is the saying that people almost say, that we live to fight another day. So you can't just go to there and fight without having remaining strength and weapon you can use to fight the next day. No. What you need to do is to apply proper risk management. When you apply proper risk management, then you can be able to live today and also fight for tomorrow. What I mean by this is this: if you trade today, you still have another money to trade tomorrow. If you trade tomorrow, you still have another money to trade next tomorrow. But if you are taking proper, if you throw your proper risk management out of board, definitely you blow your account and you lose the whole capital that you started with. Understand? And which is very, very bad. The next thing is you need to do is that forex trading is not a get rich quick scheme. Yes, of course. Forget about what you are seeing on Instagram. Instagram lifestyle of some traders is very good. I admire it. It's very, very sweet. But it is way more than you are seeing it. It's way more than you are seeing it. So forex is not a great risk scheme. No. You need to take your time. You need to take your time and learn this business. When you take your time, start trading small. Take it easy. Don't try to rush the process. No. Don't rush the process. Rather, trust the process. If you trust the process, you will make a whole lot of money doing so. Understand? Like I always say, I always say, do not use your number 1 to compare someone else number 200. No, doesn't make sense. Rather, focus on your own path. Focus on your own lane. Learn to learn the rhythm of your own life. Because if you can be able to learn the rhythm of your own life, then you can be able to move in your own space and your own intuition and your own direction. What you are seeing on Instagram is just that let it just give you motivation. You understand? Use what you are seeing online, successful traders, as your motivation, as a motivational tools for you to not give up on your dream of being a successful trader. And you keep moving small. Very soon you will reach a level. Because if you attempt to put more pressure on yourself, definitely you will take irrational decision in the market, and it will begin to apply and test your psychology, which is very, very, very bad for you to do that as a beginner trader, most especially who are beginners starting this business. So these are the common mistakes you need to avoid as a trader. The last but not the least is greedy. So many traders who are beginning this business are greedy. Greedy to the extent that they can be able to throw their risk management out of board and start maxing their account just to make big money very, very fast. These things doesn't work like that in the market. You have to take your time and trade the market. Even if this opportunity is 99% accurate, still apply proper risk management. Trade it conservatively, step by step. Very soon you will reach where others are, because if you tend to take it fast, you can blow your account, and when you blow your account, you may not see another money that you can use to trade the forex market. At this junction, let me now dive into the advantages of forex trading. You understand? Because every business that have advantages have disadvantages. Number one, you have 24 hours access to the global market chart. Yes, of course. You have 24 hours to access the forex market. This is number one advantage. Number two, high liquidity. There is a high liquidity. There is a too much amount of money to make in this business. Understand? This is number two. Number three, low cost. Unlike stock market, forex is different. There is a low cost of transaction in the forex market. This is number three. Number four, you can open a trading account and you can get verified immediately. As of course, you can open a trading account with a brokerage firm and get verified immediately, and you start trading immediately. Once you have the right knowledge and skill, you can go up immediately. Then number five is this business, you can trade it anywhere, any place, anytime. Once you have your internet, and once you have your internet, you have your smartphone, and you have your money in your trading account, you can trade this forex anywhere. You can be in America, you can be in China, you can be in London, anywhere in the world. You can trade forex anywhere in the world with your smartphone. Once you have money in your trading account and you have the right skill, you can trade it anywhere in the world. Then, disadvantages of forex trading is high risk. There is a very high risk of you losing your money in the market. Yes, of course. If you're the kind of person that doesn't like to take risk, and you're the kind of person that if you lose a small amount of money, it will pay you very much, please don't be in the forex market business. But if you're the kind of person that take risk, then foreign exchange business for you, because some people don't want to lose their hard-earned money. So if you're the kind of people that doesn't want to lose their hard-earned money, the foreign exchange market is not for you. But if you're the kind of person that loves to take risk, then the foreign exchange business is for you. Then number two disadvantage is emotional stress. Some successful traders will not tell you this, but I will tell you for free. Trading is stressful. Yes, of course. Trading is very, very stressful. You might not understand this as a beginner, but trading is very, very stressful. So you need to be very, very, very emotionally strong, stable. You need to be strong and stable emotionally for you to be a successful trader, because trading itself is stressful, especially when you lose money consistently and when you're in a losing streaks, it can stress you out a whole lot. So you need to control and manage your emotion very well. And you need to, because once you are done psychologically, you are stressed out. Understand? So you need to control your emotion. I need to control your emotion whenever you are trading in the market. That is number two. Then number three is potential for losses. Yes, of course. There is no guarantee that you end up making a profit in each trade that you execute. But what you do is you are in the business of probability. And the probability of you making money is way more higher than probability of you losing money. That is where and when proper risk management and proper education comes in. And in this channel, I will take my time and piece the puzzle for you step by step, one after the other, no rushing. I will take my time to explain these things for you, so that you need to take your time and understand the basis, the preamble of how this business works. Because this business is not just, it's not what you just step in, rushing like rush hour and rushers. No, you need to take your time, study, learn, make profit, loss, come back and learn again. With this thing, you can be able to guide yourself very well and say, yes, of course, I have grasped these things. The more you are trading the market, the more you are getting more experience, the more that you are getting more knowledge, the more you are being more advanced in the forex trading. Then you can say to yourself, of course, I have grabbed this lesson. And of course, you'll be very happy. I promise you, forex trading is a very profitable business. The moment I discovered forex trading, I just started being attention into it and started learning it and started trading small and be making small amount of money. Yes, I haven't made that big money yet, but I believe that one day somewhere I'll make that big money. But the most important thing is for you to begin and start trading. Learn the skill of forex trading. It will change a lot, because we live in a world that is economically driven. Things are changing and the way people make money are changing. Understand? So especially if you're in this part of the world, in Africa, whereby your 9 to 5 job doesn't pay you much. Understand? You need to have something that you can, another skill that you can learn that can make you another extra source of income for you to live in. So if you watch this moment, if you watch this video up to this moment, please make sure you like this video, make sure you subscribe to the channel, and also comment down below if you have any single question concerning this video. I will see you in the second part of this video. This first part is the introduction of the forex trading. Then in the second part of the video, I'll be telling you what forex trading is all about, and I will break it down for you. By then, I will take you straight to my laptop where I will be digressing everything for you, and I will list out the whole topics that I will be covering in that video. Let's head over to the next chapter. I will see you there in my next chapter. Thank you. Hi guys, welcome back again. Now that you have already understand the introduction of what the forex business is all about, right now I'm gonna be now taking you step further to the foundation. Yes, of course, to the foundation of the forex trading, down to the end of the advanced learning course. I'm going to be telling you as a beginner what you need to know, from the beginner stage to the intermediate stage to the advanced stage to semi-advanced stage to a professional level. So I'm going to be breaking it down for you in this second piece, in this second part, or this second segment of my video, because I tell you earlier on that this video will be 2 segments. So now this is the second segment. Then I'll be telling you the first foundation you need to know, the second foundation you need to know, the third foundation you need to know. Step by step process, no rushing. So make sure you subscribe to the channel, like this video, and also comment down below if you have any single question concerning this video. Let's continue, because this video of forex trading, I don't want to rush it. I want to take my time to explain everything in details, so that it will take a very long hour, so that you can be able to watch it from the beginning to the end and understand everything you need to know. Because this type of business is not the business that you begin to rush. No, you can't rush it. You need to take your time and understand every single thing. Because if you skip anything, then you can make a very big mistake in your trading account. So that is why I need to take my time and explain everything to you. So make sure you watch this video. Let's continue from where we start. And also comment down below. Ask me question. And also leave a like and comment in the comment section. As always, I will read it out from my smartphone. Then I will go down to my laptop in subsequent hours of this video and explain everything for you. Let's begin right now. The first thing in the foundation number 1 is what is forex. The second foundation is market participant. The third foundation is the base currency and quote currency. The fourth foundation is who are forex brokers. This is the foundation number 1 that you need to know. Then foundation number 2 is forex market hours, which I talk about earlier on in the introduction. Then what is a spread? Then pips and points that see the same thing. What is a lot size? What is a leverage? And also what is equity and margin? This is the second foundation of my tutorial video that I will be explaining later on in this video. Then the third foundation, because let me give you an instance. If you want to build a house, let me say a four-story building, you need to build the first foundation and lay your blocks up, build the second foundation and put the first floor, build the third foundation and put the second floor, and build the fourth foundation and build the fourth floor. So I need to guide you step by step, so that you can be able to grasp everything you need to know without rushing. Understand? So let's continue. Then the third foundation. What is step profit? What is stop loss? You learn what is stop loss and every other thing concerning stop loss. Other types. You need to learn. You will learn orders in the market, because every business have orders. The same thing as forex trading. Then you need to learn market execution. After market execution, you know what market execution is all about and everything concerning the market execution. Number 2, pending orders. You need to know what is pending order, types of pending orders, which is buy stop, sell stop, buy limit, sell limit, and trailing stop. Yes, of course, trailing stop loss is also part of execution in the market. Then let's now dive into the intermediate level. Under intermediate level, we have what is forex analysis. You will learn what forex analysis is all about. Then under forex analysis, you will learn what is fundamental analysis. Yes, of course. Still under this analysis, you will learn what is technical analysis. Understand? Still on this analysis, you learn what is sentimental analysis. Yes, of course. Because some people don't know that we have what we call sentimental analysis. But in this video, I will teach you everything in these 3 types of analysis: fundamental, technical, and sentimental. Then I also tell you which type of forex analysis is best for you. Understand? Let's now move to advanced level, which is number 1. The advanced class of number 1 is fundamental analysis. Under fundamental analysis, you will learn gross domestic product, which is GDP of every country. You will learn inflation rate or consumer price index. Under inflation rate or consumer price index, you will learn interest rates, because every country have different interest rates. You learn interest rate in this advanced level of number 1, and also you will learn what we call non-farm payroll, which is popularly known as NFP, which occurs every first Friday of every month. You will learn it in this video. Then secondly is reading the economic calendar. You will learn how to read the economic calendar. Then technical analysis, which is number 3. Under technical analysis, you will learn trend following and trend consolidation, which is the uptrend, the downtrend, and the ranging market. You will learn it. You will learn demand and supply, which is support and resistance. You will learn ways on how to draw support and resistance. Yes, of course. You will learn channels and also watch how to draw the channels, and also learn Fibonacci drawing, and also Fibonacci, or whether it's Fibonacci, but the most important thing, you will learn how to draw Fibonacci, your Fibonacci level, which is among trading indicators that are in the forex market. Then we have commonly used indicators, which I will be diving right now. We have relative strong index, which is RSI. We have stochastic. We have so many of them. You understand? We have moving average, convergence, divergence. We have moving average only. You have a parabolic SAR. These are so many indicators, but we are coming to that level. Understand? Let me just read everything out for you, then we can enter. Once we enter, we are going straight to all these topics. Then we will learn about Japanese candlestick. Yes, of course. Because as a trader, if you don't know what is Japanese candlestick is all about, I don't know the essence of you being a forex trader. Because Japanese candlestick is let me say 95% of traders in the whole world are making use of Japanese candlestick. Understand? So under Japanese candlestick, you will learn anatomy of candlestick, how the candlestick works, what makes up the candlesticks. Then you learn the importance of candlestick. Yes, of course. You learn the advantages of candlestick. Why candlestick is very, very important, and why candlestick is very easy to use over other chart over other trading charts. We learn about what is a shadow. We learn about the doji candlestick pattern, because we have different type of candlesticks. We have the doji candlestick. We have the dragonfly. We have the bullish engulfing pattern. We have the bearish engulfing pattern. We have the pin bar. We have the hammer. So we have so many types of candlestick. We will learn all of them in this segment. We have the shooting stars. We have the dragonfly doji. Understand all these candlestick pattern. You have to learn all of them one after the other, how to detect them and how it looks whenever you see them in your chart. Then you learn classical sharp pattern. Yes, of course, classical sharp pattern, and I mean double top, double bottom, triple top, triple bottom, inverse head and shoulder, rising wedge, falling wedge. These are the things that you need to learn in this part. Then after that, we'll be then going to the advanced class, which is the last topic, which is harmonic pattern, type of harmonic pattern, then types of traders. Because in this type of class, you need to know the kind of type of traders that we have. Like I have told you previously, we have day traders, swing traders, and we have day traders, we have swing, and we have position. So your personality will determine the kind of traders you want to be. Understand? Like I tell you, scalpers, day trading, and swing trading. Don't forget about these three type of traders. So 4: scalpers, swing trading, day traders, and position traders. But we are focusing on these 3 types. Understand? Then I will tell you and teach you how to create a trading system. Yes, of course. Creating a trading system is more of creating a trading plan and strategy. Then I will teach you money management. Yes, of course, how to manage your money and how to manage your capital in the forex trading. Then I will teach you trade management. Yes, of course, how to manage your trade in the market. Also, I will teach you risk management, because so many people don't know how to control their risk as a traders. So many people are taking unnecessary risk in the market. So I'll be teaching you how to apply proper risk management. Then lastly but not the least, I'll be teaching you in this full tutorial how to be and control your trading psychology, how to be calm psychologically, how to control your psychology, how to control your emotion whenever you're in the market, whenever you're trading, because people have different type of emotion. People exhibit different kind of emotion, because the way I control my emotion might not be the way you control your own emotion. So I'll be telling you how to control your emotion as a trader. This and more is what I will be teaching you in this second part of this video, which is the full tutorial. Make sure you stay tuned as I'm diving in straight to my laptop. I will be breaking everything down for you in order for you to grasp and understand everything. So let me head over to my laptop and let me continue from where I stop. Thank you, and let me see you down to my laptop. So if you are watching this video up to this moment, please make sure to like this video, make sure to subscribe to the channel, and also comment down below if you have any question concerning this video. Now let's head over to my laptop. Let me begin to break everything down for you to understand everything you need to know to start a successful business as a forex trader. Let's go right now. Welcome back to my screen once again. So let's continue from where we stop in my video. So let's continue with the full tutorial right now. What is forex? As I have explained to you before during my introduction, forex is usually abbreviated in FS, derived from foreign exchange. It means simultaneous buying and selling of currencies. And currencies are instruments in which transactions are conducted, and every nation in the world has its own currency peculiar to it. So as you can see this image below, you will see the US dollar, the euro, the GBP, the Swiss franc, the Australian dollar, the Canadian dollar, the New Zealand dollar, and the Japanese yen. So as you can see the image below, these are the image of some currencies that are being traded in the forex market. Are you getting my point now? So let's continue. And as long as people will continue to travel from one nation to other, the exchange of one currency to other will continue to happen, and therefore it raises the doubt in our mind about the lifespan of forex trading. You understand? So as long as people continue to travel around the world, that means forex will continue to occur from one places to another. Forex trading will always be involved in two currency at a time. For instance, Euro USD. For instance, Euro USD, by using, you are buying the Euro USD and at the same time selling the US dollars. By this, you are saying Europe economy is stronger than the United States economy. Forex market is dynamic and its movement and this is as a result of different micro and microeconomic activities, because there are so many activities that go on in the forex market and that play out in the country at that particular point in time. So this also goes a long way to give you indication of the strength of a currency under consideration. So let's continue. Then in the next pages, in the next chapter, I'll be telling you what are market participants. As you can see in my screen, these are different players involved in the forex market. We have the central bank, we have the commercial bank, we have the hedge funds, we have the brokers, we have speculators, and we have individuals. You understand? But most of the participants trade forex for profit motive, while the goal of central bank of different nations is to stabilize their respective economies through the instrumentality of foreign exchange stability, which is easily available through the determination of appropriate rates. Commercial banks and individuals, for instance, get involved with profit motive. You understand? So individuals and individual traders only came to forex to make money, while the central bank only came to the forex to stabilize their country's economy. You understand? So it is worthy of note here that individual participation in forex market is only 2% to 3% of global participation. So this sends signal to us that as individuals to always follow the big money movers in the market and never try to go against the big money movers in the market. So let's continue. Let's talk about the base and quote currency. You can recall in our definition of forex, we say that it is a simultaneous buying and selling of one currency against the other. The buy or sell action taken affects the first currency in the pair and the second at the same time. For instance, if you buy the Euro USD, we are actually buying the Euro and at the same time selling the USD. You understand? So in this case, the first currency is the base, while the other currency will appear at the back is the quote currency. The quote currency serves as a reference point to determine the value of the base currency. If the current price of the Euro USD is 1.200, it means that for every 1 euro, you need $1.200 to buy it. If the price of the Euro USD increases to 1.21, therefore means that more of the unit of USD is needed to obtain 1 unit of Euro. By implication, the Euro has strengthened against the USD, and the same way we can say that the USD weakened against the Euro. So as you can see the diagram, which is the Euro, which is the base currency, and the US dollars, which is the quote currency. Let's continue. Let's talk about forex broker. Forex broker, these are firms that provide traders access to trading platform where buying and selling action are completed. The success of traders depends not only on the strategy, trade management, and ability to detach emotion from trading, but also to a large extent depend on the broker. If a broker has a wide spread, which is the difference between the bid and ask, which is called broker's commission, there is a high tendency that profit margin available to the trader will reduce. In other words, the cost of transaction is too high. As you explore the world of forex, I therefore charge you to choose a broker that gives you a minimum cost on your transaction to guarantee quicker return on investment. It is very, very important. So towards the course of this video, I'll be dropping a link to my broker so that you can click the link and make use of the brokerage firm that I'm using. Let's talk about the market forex hour. The forex market opens 24 hours from Sunday 22 o'clock GMT, which is 17 o'clock Eastern Standard Time, to Friday 22 o'clock GMT, and which is 5 o'clock 17 o'clock Eastern Standard Time. This means that you can place and close order within the given time. Each section has active time. This is when the specific countries in the region are awake. So we have so many market forex sessions. So it depends on the kind of session and the kind of country that you are watching me from. Then you will know your session in your country. I will show you now in the next clip. Let's continue. As you can see right now, this is the time zone table. As you can see the European zone, you can see the North American zone, you can see the Asian zone, and you can see the Pacific zone. So all these zones have so many zones. You have City and London session, Frankfurt session, Chicago, New York, Toronto, which are Asia, Tokyo, Hong Kong, Shanghai. Then under Pacific, you have Sydney and Wellington. So all these things are so many sessions that are being traded around the world in the forex market, and it is advisable to trade when there is a high volatility in the market. The most active session to trade is the overlap session, which is from 13 o'clock GMT to 16 o'clock GMT. So as you can see the diagram below, as you can see the trading session where there is overlap between the London session and the New York session, which begins at 13 o'clock GMT, which is 8 o'clock in New York, and ends at 4 o'clock GMT, which is 11 o'clock in New York. This is the most busy area and the most busy period during the forex market, where there is a high fluctuation and high volume of trading amount of money going on through this period, and it's very, very active. And this is the period where most traders make a whole lot of money. You understand? Let's continue. What is spread? Spread is the difference between the bid and ask of a given instrument. An example of a typical forex trade is this. Every trade involving two currency called a currency pair. In this given example, we will use euro and US dollar. At any given time, euro may be worth 1.140 times USD. You may believe the euro will rise against the dollar, so you buy it at asking price, but the asking price won't be exactly 1.140. It will be a little more, perhaps 1.14001, which is the price you will pay to trade 1 euro. Meanwhile, the seller on the other side of the trade won't receive the full 1.100. Rather, he will get a little less, perhaps 1.13999. Then the differences between the bid and ask is in this instance is 0.002, and is the spread. So this spread is more of like is a commission that a broker charges you for them to facilitate your trade on their platform, and that is what the specialist keeps on taking and facilitating your trade. As I have always said it in my introduction, spread varies from one broker to the other depending on the type of pair that you are trading. You understand? So to minimize the spread incurred from brokers, trade during the most favorable hour, which is during the overlaps. When there are more market participants, competition for this business increases and market makers often lower their spread to capture it. Also, avoid buying or selling low traded pairs. You understand? So go for more and most traded pairs in the market. So let's continue. What are pips and points? Pips stand for point and percentage. More simply though, a pip is what we call in FX a point for calculating profit or loss. So it is a standardized unit and a smallest amount by which a country's currency can change. For US dollar related currency, it is being related in 0.001, while for Japanese yen related currency, it is being related in 0.01. You understand? Let's continue. As you can see the diagram, you can see the euro, you can see the US dollar. You can see the euro selling at 1.0092, while the dollar is selling at 1.0094. Then you can see the difference between the bid and ask, which is 2, which is now the spread that your brokerage firm charges you for them to facilitate your trade. You understand? So let's continue. What is lot size? Lot size, historically, currencies were traded in specific amount called lots. So lot size directly impacts in the risk you are taking in a trade. And in trading, we have standard lot size for a lot, which are 100,000 units. There are also mini lot size of 10,000 units, and also there are micro lot size of 1,000 units. As you can see the diagram below, you see micro lot size, which is 0.01, mini lot size 0.1, and standard lot size 1.0. And all these things have different units. While the standard unit goes for 100,000 units, the mini lot size goes for 10,000 units, while the micro lot size goes for 1,000 units of the base currency. Which means that for every 0.01 you are using, you are making or losing $10 cents at a pip movement. For every 10,000 units you are purchasing or selling, you are making $1 or you are losing $1 at a time. And for every 100,000 units you are purchasing, you are making $10 a pip movement, or you are losing $10 a pip movement. So that is the general meaning of all these things that you are seeing in this my screen. So to take advantage of relative small move in exchange rate of currency, we need to trade large amount in order to see any significant profit. Yes, of course. So the more we trade large amount, the more we make money, and at the same time, the more we lose money. So in the trading terminal, standard lot size is represented by 1.0, which I have already said previously, while the mini lot size is represented by 0.1, and the micro lot size is represented by 0.01. When you have no open position and so no floating profit or loss, then your account equity and balance are still the same. Let's continue. What is leverage? Leverage in Forex is the ratio of traders' capital or fund to the size of brokers' fund made available for trading. In other words, leverage is borrowed funds in order to scale up investment capital for potential return. For instance, a leverage of 1:500 means that the trader can trade a volume of as much as 500 times invested capital. So as good as it sounds, it is also important to note that traders can also lose their invested capital easily when the trade goes against them using higher leverage. That is why in some countries like United States of America, they protect their citizens by regulating their maximum allowed leverage. You understand? So let's continue. What is equity and margin? Equity is the summation of your account balance with the floating profit or loss of your open position. The equity changes based on price fluctuation from your current position, open position. For example, equity equals to balance plus floating profit or loss. When you have no open position and so no floating profit or loss, then your account equate and balance are the same. For instance, assuming you have open trades running in profit of $2,000, equity will be $2,000 plus your account balance. Also, if your current position is running in a loss of $2,000, your equity will be account balance less than $2,000 that you started with. So let's continue. What is margin? Margin is calculated based on leverage. Margin is an amount of money put down as collateral for running a position or trade. For instance, let's say you have a $10,000 account and you want to buy 1,000 euro against USD. How much USD do you have to pay to buy 1,000 euro? Let's assume that the euro USD is at the rate of 1.4314. It means that each euro equals $1.43 for 14 pennies. Therefore, to buy 1,000 euro, you have to pay 1,431.40 US dollars, which is 1,000 euro equals to 1,000 times 1.4314. Therefore, 1,000 euro will give you $1,431. So if you take $1,000 euro USD long, you buy the 1,000 euro against USD from the $10,000 account, then has been locked in this position as collateral. When you set the volume to 0.01 lot, which is 1,000 units of the base currency, and then you click on the buy button, 1,431.4 from your account will be paid to buy a 1,000 euro for against USD. This locked money, which is 1,431, is in this example is called required margin. It's the required margin for you to be able to take that trade. Understand? Let's continue. What is take profit? Take profit is also known as target price, always referred as TP. It is an order that is sent to the broker, informing the broker to close a running position or trade when the price reaches a certain target or price level. Let's continue. As you can see the diagram below, you see the entry, you see the take profit, and you see the stop loss. So this order can be either done manually or electronically. Electronic TP is an order that you send on the trading platform containing the target point profit price for which the position or running trade should be closed, whereas manual take profit is done without setting price on the trading platform, but the trader takes action, but the trader takes decision to the manual close to the take profit. The reason why traders will take the take profit is to be able to manage their trade better, so that when the market goes in the unanticipated direction, the profit will not be wiped out. Understand? So let's continue. What is stop loss? Stop loss is the exact opposite of take profit. This is an order that is sent to your broker, informing your broker to close a position or trade when the trade reaches a certain level in your loss. So SL is set in order to take out a position in loss if it goes against the analyzed direction, so that the account will not be wiped out. So this order can be done manually or electronically, just as we have explained in take profit above. Understand? So we have different order types. So in order type, you have market execution. Whenever you hear of market execution or instant execution, we mean a buy or sell at the current market price. There is no need waiting for the price to get to any level before the trade is taken. These orders imply that the trade setup at the point in time is valid enough to be taken after going through series of analysis, as may be deemed by fit by the trader. Some of the reason for market execution could be a breakout of a trend line or counter trend line, or a retest of broken resistance or support, or fulfillment of a golden Fibonacci ratio of 61.8, or even break of one psychological level or the other, etc. Some or all or above can be the reason to set orders type of pending orders. So that as we are going through this video, let's see those other types that you can be seeing in this trading course. Let's continue. We have pending orders. Pending orders, these are requests made by a trader to the broker through MetaTrader 4, indicating the price level, indicating a level of a position should be open or closed. The appropriate use of pending order can greatly help to cut losses and catching up with early market movement. However, the use of pending orders without proper analysis could cause early activation of trade, which is resultant effect of avoidable drawdown. The following are commonly used orders in forex trading. Number one, we have buy stop. What is buy stop? Buy stop, this is an order set to instruct the broker to activate a trade at a certain price level, which is also the current market price in a bullish direction. Whenever the market goes to set the price in the buy position, the trade is activated and the market does not move to set the price, then the trade is not activated. This order is particularly important because it is afford traders opportunity to cash trades at good prices, especially in situations where it is expected that price reversal may be difficult at the buy stop price. Understand? So as we can see, this is the buy stop in this diagram. This is the buy stop when order placed above the price and price keeps going up. Then this is the sell stop when order placed below the price and the price keeps going down. So let's continue. What is sell stop? Sell stop is the opposite of buy stop. It is an instruction traders give to their broker to sell a pair at a price which is below the current market price in a bearish market. This order is given with the belief that if the market execution is done at the moment when the drawdown is anticipated, but sell stop order is given to activate a trade where price reversal in buy direction may not be plausible. You understand? As good as sell stop is, it is used as one to sell back to. After through analysis, market could behave differently due to fundamental news release or as discussed earlier, which could undermine technical analysis validly done before pending orders was set. This could result in sell stop order not being activated and stop loss hit thereafter, meaning that the market has gone to the opposite direction. So what is buy limit? Buy limit is an instruction to the broker to activate a buy trade for a selling market. This means that the current market price is too expensive for the trader and he therefore wants the market to sell off before the buy order is activated. So as you can see the diagram, this is the buy limit orders that you place when you believe the market will go up, you go back up. Then sell limit is the order that you place when you believe that the market will go back down. So as you can see the diagram, this is the buy limit and this is the sell limit. So let's continue. What is the sell limit? This is the opposite of buy limit. It is an order set to sell off a pair at a given price which is above the current price in a buying market. If after analysis we believe that certain resistance level may not be broken when the market when the market reach that level in a bullish market, we could set a sell limit to ensure the broker through our MetaTrader 4 to sell the pair at that price. You understand? The danger of this order is that we could be caught in a drawdown if price decide to break through the target price or resistance area used as yardstick to setting the sell limit. You understand? Let's continue. What is a trailing stop? A trailing stop often goes like this. When traders often time want to maximize their profits by trailing their stop profit, this order can be set to a MetaTrader 4 on the desktop or your laptop by the function is not available for now on the mobile platform. Some traders prefer to set their trailing stop at 10 pips, while others prefer to set their own in 15 pips or 20 pips. If the price move in the trade direction, the profit also increase until the market pull back to the number of pips greater than the number of pips set after trailing stop. You understand? As you can see in the diagram below, you can open the position here. Then when the market start moving in your favor or when the market moving in your direction, you remove your stop loss and put it in a protection where you can protect your profit, and you are now running on a risk-free trade. Understand? It is called training of stop loss. Let's continue. Let's go to Forex analysis. There are three main types of analysis. Success in trade in the forex market is highly dependent on proper analysis and predicting the future market movement, either using economic news release or past price movement. Now let's take a closer look at the three types of forex analysis, which are fundamental analysis, technical analysis, and sentimental analysis. Let's continue. What are fundamental analysis? Is the process of forecasting price movement in the market using important geopolitical and economic news release which directly affect the behavior of the currency pair. This is done based on macro and microeconomic indicators as well as the news background. Fundamental analysis is tracked using economic calendar. Economic calendar is a tool used by traders to keep up with each country's news release. It is a table displaying date, time of the news, currency, and expected impact on such currency, which could be high, medium, or low. Example of popular economic news release is the United States non-farm payroll, which is called NFP, that occurs every first Friday of every month. The economic news forecast has great impact on the Euro USD and some other USD related pairs. As you can see, this is the diagram of Forex Factory News, which is one of the economic news calendar platform or website, as you can call it. So we have forexfactory.com. We have my FX book website, which offer a lot of assistance on identifying how fundamental release could affect the value of the currency. So you can go and head over to any of the Forex news websites, which is Forex Factory or my FX book, and go and check out any currency pair that will affect your trading. You understand? And find a way to avoid it. If possible, don't trade that day. Wait for the next day before you trade again to avoid blowing your account. So let's continue. What is technical analysis? It is a method of forecasting the currency pair behavior based in its past movement. Technical analysis believes analyzing pattern in price history is enough to determine a higher probability trade setup. If price reflects all the information that is in the market, then price action is as all it needs to really make a good trade. Well, because history, they say, tends to repeat itself, and as a result of this, it is mostly wide used by all type of traders in this technical analysis. Because technical analysis is done using a chart. This is because historical movement is the best visualized in chart. Traders look at the past data to spot trend and specific pattern, which help in determining where the price will likely to go or head to. Understand? Because technical analysis also make use of indicators like relative strength index, stochastic, Bollinger Band, MACD, etc. to determine the future price direction or reversal. All these indicators are further explained in the next pages of my course, so you can grasp the respective names and its application to further help you make a good trading decision. Let's continue. Sentimental analysis. The market is a This sentimental analysis, the market is a place that represents all of the traders and what they feel for the market. At the same time, traders feeling and trade position forms the sentiment of the market, because it is the feeling of the traders and their emotion that form the sentiment of the market. You understand? The market is made up of mixed feelings, various ideas, and trade bias. This makes it really difficult for a retail trader to move the market to his or her behavior, no matter how strong his opinion might be. If more people do not think so, your analysis would be proven wrong. It is the market for you, not not a retail traders that can do it. Understand? You have to be cautious of what the market is made up of. Think like a big player to make money like them. You understand? Because there are big players in this market. Because you have so many big traders, you have the hedge funds, you have the big company who are trading with millions upon millions of dollars. So you coming up with a small amount of money, your money cannot move the market. The only money that move the market are the big hedge funds that move the market. You understand? So keep in mind on how the market feel and gauge it into any trade that you make or the trading strategy that you use. So you learning the gauge to gauge the market sentiment is a multi-billion dollar skill set, and this can be gained through consistent study of the market and putting into consideration how the big player acts, and then you react in line with the market sentiment. You understand? So let's continue with it. Which type of trade forex analysis is for trading is the best? Here comes a controversial question. Just as you have in other sphere of studies, one-sided extremism has no chance in forex trading, because you have, as you advance in your journey as a trader, a lot of opinion will come up. Do not be deceived. No one is wrong or right in its entirety. Funny enough, right? Everyone is predicting, and so many people are predicting, and the markets reward the person who was able to merge all of these three analysis and able to apply them hand in hand to come up with a better trade idea. You understand? But the bottom line is this: do not rely in just one analysis. Apply each of them, which is simple. Don't rely on only technical, but apply the technical, apply the fundamental, and also apply the sentimental. Apply the three of them. So all of them are very, very important. Respect chart pattern, supply and demand level when formed. Also take caution on time of high impact news, and gauge the feeling in the current market. Follow price and money will follow you. Understand? Follow the price and money will follow you. Let's continue. Fundamental analysis. These are analysis that has to do with the overall state of the economy of any country. Forex traders have over time capitalized on the internet relationship of some of these key indicators to predict the strength of the economy and by extension its currency. It is then means that if you are able to appropriately link the various microeconomic indicators such as gross domestic product (GDP), inflation rate, or other so-called wise consumer index, employment change, interest rate, housing, production, earning, etc., when will we be able to stand a chance to predict the price movement? Understand? As we have learned in the various type of analysis, fundamental analysts do not concern themselves with the study of charts and its analysis, but rather through their judgment on the recent happening in different countries of the world. Let's look at some of the common fundamental news releases that can influence the market price. For example, gross domestic product. It is a measure of total output in the economy. If the economy is doing well, then the GDP number in percentage will be greater than the expected value. When this happens, investors will have confidence on the economy, and it consequently causes the local currency to strengthen. If the GDP of economy is less than the expected value, then there will be depreciation in the country's currency, and such currency will be bearish relative to the other currency. Understand? So when the economy is good, the currency of a country is good. When the economy is bad, the country of economy is bad. Let's continue. Number 2, inflation rate or consumer price index. This is general and the persistent rise in price value. It is not too good for the economy as the consumer real income reduces. When the cost of production rises, then the producer passes the cost to the final consumer, making them to pay more even when their income has not increased. Inflation is measured with CPI, which captures the price of basket of common goods over a period of time. If this number in percentage is greater than expected level, then the currency of that country will fall at that moment. If it is less than expected, then it is positive news for the economy. Buyer gets ready to go long on the currency of that country relative to other currencies. You understand? Let's talk about the interest rate, which is number 3. Interest rate is determined by the central bank of any economy. It is the key rate that is used to regulate economic activity in the country. A country in need of foreign direct investment will increase its rates. What is the implication of interest rate in Forex? The implication of foreign exchange is increase in rates causes the local currency to appreciate, and traders therefore go long, which is buy, to benefit from increase in value. What is non-farm payroll, which is number 4? It is the total employment in the United States. NFP is released on first Friday of every month, which I have already told you previously, and it does not include farm workers, private household employee or non-profit organization employee. A figure greater than expected value is a good for the economy. Hence, the rise in the value of dollar should be anticipated. If the employment changes in less than expected value, it means that the economy underperformed under the period of consideration. What is the portent for the dollar is this depreciation of its value. For instance, if we get less impressive employment change, then we should expect the USD to fall relative to other currencies, which means the euro USD will rise, the GBP will rise, the Canadian dollar, the USD Canadian dollar will fall, then the USD JPY will fall. Then reading the economic calendar. These news releases are categorized into stages depending on their impact on economy and by extension on their currencies. There are different signs that you see. We have the red folder news, which is high impact. We have the yellow folder news, which is low impact, and we have the orange folder news, which is medium impact. Just as you can see below, the yellow impact news have the yellow design have low impact news, then the red have high impact news, then the orange have medium impact news. So when you see the red, just know that currency pair will have a high impact on the market. When you see the yellow one, just know that the currency pair will have low impact on the market. Then when you see the orange one, yeah, you know that the currency pair will have a medium impact on the market. This is what all this thing means. And websites where news release can be obtained in this platform, you have investing.com, you have forexfactory.com, and also you have my FX book, etc., and so many other Forex news websites. But these news websites are the main: investing.com, forexfactory.com, and myfxbook.com. These 3 are the best, you understand? So let's continue. Technical analysis. Under technical analysis, we can learn about trend and flat or consolidation. What is a trend? Trend is a market condition for price to move in a particular direction over a period. Price could be either downtrend or uptrend or sideways. Understand? So when you see the market is going uptrend, it's moving in the series of higher high, higher low, higher high, higher low, higher high. While the downtrend, it moves in the series of lower low, lower high, lower low, lower high, lower low. Understand? That is the downtrend, and this is the uptrend, as you can see in the diagram below. Let's continue. So if it is upward trend, traders say it is a bullish trend, whereas if it is a downtrend, traders say it is a bearish trend. Trend can be spotted by visual observation or by connecting 2 or more peaks and troughs. You understand? Trend can be a long-term, intermediate, or short-term trend. Success in Forex can be tied to the ability to identify trend and take a position in line with the trend. This is a popular saying by traders: the trend is your friend. Never forget this saying. If you are able to remember it and apply it in your trading,
money would come after you. Understand? Trend can be spotted using price action, trend line, moving average crossover, and combining more technicals in order to make your trading decision. Then we have flat or consolidation. This is a market condition that is neither rising nor declining. When the market does not have a specific identifiable direction, the market is said to be choppy or moving flat. There are various markets which can be called among which are sideways movement, range bound, or consolidation. So it's either you call it sideways, range bound, or consolidation market. As you can see it in the chart. So the market is moving in between the up down up down up down. So it doesn't have any direction. It is stuck in the same movement. You understand? So it is advised by most people. It's advised most for you to stay out of the market during this action, because there is either low volatility or bias, and seller did not tend to place a trade in this specific identifiable direction. You understand? So there are various strategies merged with indicators or price action successfully used in trading the shopping market. Some of these are indicators that suit a flat market is the Bollinger Band or the oscillator. The idea is to find a trading style that fits your personality and then adopt the trading system. Understand? So let's talk about support and resistance. So what is support and resistance? Support and resistance, this is the backbone of technical analysis. You understand? Yes. Funny enough, everyone seems to have their own ideology as regards to plotting support and resistance. But notice that support and resistance is the backbone of technical analysis. Let's continue. And here is how it looks like. When you see the support and resistance, when the market moves for support, it hits resistance, it returns to support, form another support, it hits the resistance, hit another resistance, form the support, and hit another resistance. So from this diagram, you can deduce that the bull market, that it is a bull market, because the zigzag is moving upward. If you notice that, when you read good, that show you that definitely grabbing the whole gist. Understand? Let's continue. When the market move up and then pull back, the peak reached before the pullback, forming a selling, popularly known as resistance. The market does a short pullback. Afterward, it continues upward. The level it goes to is considered as the floor, known as support. You understand? Support and resistance is not just a random area where price turn around, but there are potential sellers waiting to short at that area. Resistance point, which is called a resistance point. So also there is a potential buyer waiting to buy long, buy at the key support level. All of these players and all of these buyers and sellers work together to send price lower, make up the supply in the supply and demand equation. More supply than demand, price fall. More demand than supply, price rises. So it's either you call resistance supply or you call support demand. So another name for resistance is supply. Then another name for support is demand. Most traders base off of their trade on support and resistance principle, and it is the proven way of trading the forex market. Ways to draw support and resistance. Support and resistance should be viewed as a line rather than as a zone. With the above being said, let me outline the process I personally use as support and resistance. You understand? I use psychological level and sub-psychological level. They are round up numbers that the big players in the market pay attention to. So they are derived simply by using the horizontal line on your chart. The horizontal line are targeted to as round up numbers on your chart. For example, let's say you add a round up number of euro, and the level to place the horizontal line would be 1.1300, 1.1400, and 1.1500. Then so your sub-psychological level will be 1.3500, 1.15, 1.14500, and 1.1500, etc. Let's go. Understand? As you can see the image below, this is the image of psychological level. These are the image of psychological level that you can see that I have marked my trend line, my line that I'm using to know my demand and supply. Understand? So another powerful way to draw support and resistance is number one. Select any of your favorite charts. Follow the process as you're watching this video, and follow this guide as you get along. Mark out all the swing high, which are the peaks, and low, which are the troughs. This can be done placing a line on this level. You understand? As you can see, the clean chart, you can drop it by knowing the highs and the lows in the market, or by marking the swing high and swing low in the market. Like I've told you before, series of lower low, lower high, lower low, lower high, lower low. So mark the lows and the high, then you can know how to mark the support and resistance. Let's continue. Then connect the highs or low using the horizontal line. So when you connect the highs and lows using the horizontal line, then you can be able to mark your support and resistance and mark it at those areas of reaction in the market. You understand? Let's continue. Now you may compare the differences, which is almost the same as which is almost the difference between what we did with psychological and sub-psychological level. But difference exists to define the support and resistance level. Based on moving average, MA is abbreviated as moving average, acts as a dynamic support and resistance, as you can see more under technical indicators. Based on other technical indicators like Fibonacci retracement, I'm glad that you are getting along with this. So don't be seem to get more or understand. So if you don't understand it, watch this video over and over again so that you can be able to understand it. And remember, practice makes perfect, because the more you practice, the more you understand. What is channel? Channel is formed by connecting at least two consecutive swing lows and high using the trend line. Price channel is a trading technique that is borrowed from the trading trend line. Trade signal is taken if price breaks any of the parallel trend line drawn. You understand? When combined with support and resistance and Japanese candlestick pattern, offers a great trading system. This system requires a lot of practice and analyzing the market structure. You understand? As you can see the diagram below, you see how to draw the channel, which is the sliding support and resistance. You understand? As you can see them below. So how do we draw the channel on the chart? First, we spot a price action forming a lower low and lower high, moving in the same intensity to the downside. And in this case of uptrend, we place the trend line at the higher high and higher low parallel to each other, trying to spot a trending price move to the upside. We get to a trade upon the break of either of the parallel line. You understand? So let's continue. What are Fibonacci level? Fibonacci level, this is a common tool used by technical traders to spot reversal or continuation areas in the market. It is based on key sequence of numbers as identified by popular mathematician Leonardo Fibonacci in the 13th century. The Fibonacci sequence number is as follows: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, and so on and so forth. Each term in this sequence is simply the summation of two preceding terms. The similarity with which this sequence is that each number of the sequence is approximately 1.168 greater than the preceding number. So this relationship is the foundation of common ratio used in the retracement studies. Understand? The key Fibonacci ratio of 61.8, also referred as the golden ratio or the golden mean, is found by dividing one number in the series by the number of that follows that. For example, 21 divided by 34 equals 0.6176, and 55 divided by 89 equals 0.6179. Then, secondly, the 38.2 ratio is found by dividing one number in the series by the number that is found two places at the right. For example, 55 divided by 144 equals 0.38. You understand? Then, the third one, 23.6 ratio, is found by dividing one number in the series by the number that is three places to the right. For example, 8 divided by 34 equals 0.2352. Don't get bored with the mathematical terms. Let's show you where the Fibonacci tools is located in the trading platform. Then you can navigate to the top right corner of your trading terminal. If you are making use of the system, or if you can make use of the smartphone, go to your trading terminal, which is the MT4. Then go for insert. when you go to insert, you look for Fibonacci. When you look for Fibonacci, click on Fibonacci retracement. As you can see the diagram below, go to your insert on your MT4 in your laptop, download it, go to insert, go to Fibonacci, then click on the retracement. Then the Fibonacci retracement will appear. You will see it there for yourself and test it and play around with it. As you can see the image above, there are other forms of Fibonacci like Fibonacci retracement, time zone, fan, X, and expansion. Do you really need all this before you can start trading? Not really. You don't need all of them. Just only the Fibonacci retracement will help you for you to see and apply these things that I've already teaching you. Understand? The idea here is for you to know how to use it and its application when necessary. Understand? For a lot of traders that I have seen, some only make use of Fibonacci retracement too and a little bit of expansion. This is because of its simplicity and applicability in any trading instrument. You understand? They can be used to confirm support or resistance, hence used as stop loss and also take profit level. However, the use of this tool is subjective. Traders use this tool in different ways. The most important rule on how to use it is to plot the tool from the trough of the peak of the current price market structure. Understand? As you can see the image below, this is how to use it from the top of the price to the trough, from the peak of the up of the market into the trough. This is how to become able to map out your Fibonacci retracement level. As you can see, this is the market. This is the 23.6. This is the 36 point. This is 38.2. This is the 50% Fibonacci, and this one is 64. Then the other one is 100% Fibonacci. So this is how to draw the Fibonacci level. You understand? So let's continue. Let's go to about another level, which is indicators. What are indicators? Technical analysts use indicators to simplify their trading system. Indicators are used to analyze price data to generate a tradable buy or sell signals. You understand? Indicators are based on some of these or some referred rules of theories developed by experienced traders, which is programmed to identify potential trade setup when those rules are met. You understand? Using indicators is a great way for you to have an added simplicity to the trading system, but again, it shouldn't be overcomplicated. So you should not overcomplicate your trading system. You understand? You should keep things simple. Understand? So that you don't overcomplicate yourself when trading. There are various indicators available in the trading terminals. So if we utilize the combination of support and resistance and the price action, you can make a consistent trader in a long run. You understand? So knowing the perfect one to use for any market condition is a prerequisite to success in the trading. Understand? So we have so many indicators. We have Fibonacci, we have alligator, we have average directional movement, we have average true range, we have also oscillators, we have B. Williams, we have oscillators, we have so many indicators. So don't just use all of them, just play around with some of them, but most especially focus on the price action. You understand? Focus on price action. So in my subsequent video, I'll be able to break down the price action trading and price action tutorial for you more and more. You understand? So we have indicators to determine current market condition as well as oscillator. Some are used to measure volume or momentum in the market, etc., as known as the image below. We will also discuss commonly used one for the purpose of this video and for this lesson. Understand? So commonly used indicators are, for example, the relative strength index. The relative strength index is a technical indicator that falls within the oscillator family. You understand? It is a leading indicator, meaning it signals potential trade setup prior to the price event on the chart. This means that RSI is likely to generate early signals, reversals, and continuation prior to price event, but then again, the signal can be false or premature. So the default setting in most trading platforms are period of 14, while some traders find 7 period more reliable. So it can be tweaked to suit any trading system or trading style that you like. So therefore, the need to combine RSI with other forex trading tools will make a good trading system. Then, how to use RSI. This indicator is unique in its style of plotting overbought and oversold condition in the market. As you can see in the diagram below, look at the indicator. It can be used to plot the overbought and the oversold trading style in the market. So but the indicator oscillates from 0 to 100. You understand? As you can see the diagram below, let's continue. Below 30 indicate oversold. You understand? Yes, below the 30 indicate oversold market condition. You understand? So while above 70 indicate overbought condition. So it can also be used to determine the current trend condition of the market. As you can see, you can use this indicator to determine the current market trend direction in the market. You understand? Let's continue. For an uptrend confirmation, make sure that the RSI line is above 50 level, just as you are seeing below. So as you can see below, make sure that the market level is above 50. You understand? So let's continue. As you can see the diagram, make sure that the indication level is above 50 so that you can be overbought. You understand? While in a downtrend, ensure the RSI line is below 50. You understand? Then we have stochastic. The stochastic indicator is classified as an oscillator since the value fluctuates between 0 and 100. Stochastic measure momentum of price. Stochastic is a theory propounded by George Lane in the late 1950s. He said stochastic measure the momentum of price. If you visualize a rocket going up in the air before it can turn down, it must slow down momentum, always changing in direction before price. So it has two lines where one is lower than the other. A signal can be generated upon the cross of those lines. Then the default setting is most in trading platform is 533 K period and D period, and slowing respectively. You understand? Stochastic also tells you when the market is overbought, understand, above 80 or oversold or below 20. As you can see the diagram below, this is the stochastic indicator. It is oversold below 20 and overbought above 50. You understand? Let's continue. It is a triple principle to buy when it is oversold and sell when it is overbought, as seen in the image below. Stochastic can be used to spot market reversal when it is either overbought or sold, and also spot divergence. When it is overbought region, it means the strength or momentum of the buyers is weakened, which connotes likelihood of a reversal and vice versa. As with other trading tools, stochastic is best when combining it with other trading tools, support or resistance and candlestick formation, in order to form a great trading system. It will be combined with moving average indicator, Bollinger Band, etc. You understand? Moving average convergence divergence. The MACD is based on moving average, and this means that its idea for analyzing momentum, trends following, entries, and riding till the momentum is exhausted. You understand? The default setting in most trading platforms are fast EMA 12, slow EMA 26, and MACD SMAA 9. You understand? These are the first settings of this indicators in some trading platform. Let's go for MACD usage. It can be used as an oscillator to spot overbought and oversold condition. As you can see in the diagram below, this is the diagram of MACD indicator. Take a look at how it looks like. Then you can go to the chart and play around with it. The above highlight level are considered overbought, and oversold level, others known as bullish, others known as buy or sell exhaustion. Understand? Center line crossover 010. When the MAD line crosses over from the negative region to the positive region, it is called the bullish crossover and indicates a bullish momentum. Understand? So as you can see, when the negative crosses into the positive, then it indicates the bullish crossover. Look at it in diagram. So this is how you look. And also when the crossover from positive territory is negative to negative territory, it's called bearish crossover, and that indicates bearish momentum in the market. Divergence trading, just as the name implies, MACD is used to majorly spot divergence. And it is and what is divergence? Divergence occur when an indicator and price are heading to the opposite direction. This further signals a reversal in that given market. There are a couple of other indicators that can be used to spot divergence, like RSI, stochastic, etc. You understand? As you can see it in the diagram below. Let's continue. So I see the diagram below. Let's continue. You can see how price tumbles slowly to the downside just by merely spotting divergence on a price. And MACD can potentially make you a fortune of the forex market. I'm telling you the truth. You can go to your chart with MACD, apply to the second window, backtest for divergence entry. Take note of how price reacts when divergence occur. Understand? MAD is best when combined with other trading tools like support and resistance, candlestick formation, and other form of great trading system. Understand? Don't just trade indicators only. No, infuse them with proper support and resistance. Infuse them with other technical tools, or with other technical strategies. Then it will give you a good result. Understand? Don't just trade only with technical indicators. No, also apply use of price action and technical indicator. Then it will be more confident and more result. Understand? Let's head over to another trading, which is moving average. It is a trend following indicator. The moving average is a line created by taking the average of closing or open price of the last group of candles based on that moving average number and putting a dot and then connecting the dots as each candles form. There are four MA methods. In method there are four, which are simple, exponential, smoothing, and linear weighting. Understand? So this indicator that goes through this line chart are called the moving average. Moving average are used to forecast the future price, and by merely looking at it, it can tell you the trend of the current market on that particular time frame. You understand? Just merely looking at this indicator now, you will find out that this thing is moving on a downtrend without somebody even telling you yourself, or without even buying any software to determine the trend. With your main eye, you can see that this market right now is moving in a downtrend when you import your moving average indicator. So let's continue. Like one who have seen all, it is 50 MA on the 4 hours time frame. As you can see this indicator right now, this is the 50 moving average that is plotted on the 4-hour time frame of the Euro USD that I screenshotted. Understand? So the simply above is taking above 50, which is recently formed candle. Add it up, divided by 50, you to get a number average to put dot at the last candle position. When the next candle form, it disregard the first candle from the last group and start the calculation again, and place a dot. Then the dots are connected. Moving average can be used to determine trend, just as earlier stated, as trend following indicator. You understand? MA also acts as dynamic support and resistance. Some traders base off of their support and resistance on MA pick trade when the MA is either broken or retested. Let's continue. As you can see them, when the market is moving downward, and this is a 50 moving average, then some traders can place their trade off on from this moving average. Understand? Some traders can just take trade based on this support and based on this level. They can use this moving average to mark the support and resistance. Understand? Let's continue. As you can see the diagram below, it can be used to generate potential buy or sell entry signal. This is perhaps one of the most common trading systems. 2 or more MAs are plotted on the chart. This is usually a smaller moving average and a larger moving average. A potential trade signal is generated when there is a cross to the downside or upside. As the case may see, you can see the chart below. This is 2 moving average. one is 50, the other one is another moving average. So you can use it to determine the trend of the market. It can, so because some traders and so many traders are using it to determine the strength and the trend of the market. As you can see below, the image above shows two different exponential moving average. You understand? The magenta of 20 MA, where the blue one is 40 respectively. From the top left corner, you can observe that when price started leading to the downside, the magenta crossed the blue downward, such as the blue stays above. At this time, moving average traders get on the sell to ride along with the trend. You understand? Somewhere at the bottom, price started heading to the upside. Then the magenta crossed the blue of the upside, signaling a buy entry. Understand? It is a worthy of note that the MAs follow the price and not the other way around, as many amateur traders think. Hence, the MA is considered a lagging indicator as it shifts according to the price movement. You understand? Parabolic SAR. One very interesting thing about parabolic stop and reverse is its simplicity. This indicator has three main functions: provide potential buying or sell signal, provide potential exit signal, and highlights current signal direction. As you can see in the diagram below, this is the parabolic SAR. It gives you potential signal to buy and also give you potential signal for you to sell. If you look very well in this diagram below, this is parabolic SAR the parabolic SAR indicator. It gives you signal to buy and also give you signal to sell, as you can see in the diagram below. You understand? Let's continue. The simple way to understand this indicator is to buy when the dots are below the candle and sell when the dots are above the candle, just as explained with the blue and red arrow in the chart, where blue is for buy entry and the red is for sell entry. Hence, that is why it is best to use in a trading market. Using it in a shopping market will definitely generate a whole lot of false signal. So this indicator is best to use in a trading market. You understand? If you want to trade in the trading market, this indicator is best for you. Don't use it in a shopping market. No, it works perfectly on the trading market. Let's continue. As you can see it, this indicator SAR, parabolic SAR, works perfectly on the trading market, on a trending market, whether it is a trending upward or it is trending downward, as you can see in the diagram. So it is a trend following indicator, also popularly used by traders to set trading stop loss. So the parabolic SAR effectively operates like a trading stop in uptrend. The SAR works to gradually lock in profit or the pull stop closure to break even. On the basis of its position below, the price reverse in the case of downtrend. Understand? Let's continue with the next chapter, which is candlestick. But in this level, this candlestick, I will explain more of this candlestick because candlestick is another topic that I will take my time to explain for you guys. So I will take my time to explain for you guys in the candlestick. So if you have watched this video up to this moment, my next video will be candlestick. Understand? My next video will be candlestick. So make sure you watch this video and also subscribe to my YouTube channel because I'll be explaining candlestick, because candlestick is a full course on its own. So I'll be explaining everything concerning candlestick on its own from the beginning to the end. So if you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my channel, and also comment down below if you have any single question concerning this video. And I will see you on my next video episode, which is on candlestick. I will take my time to explain everything on what is candlestick, the anatomy of candlestick, and how the candlestick market works. So make sure you stay put and subscribe to my channel, and also watch this video in my next upcoming video. And I will see you in my next video episode. Take care, stay safe, and bye for now.